Risk number one, this first risk is instability masquerading as income. So we all know that the markets bounce around. Some days are up, some days are down. If your paycheck depends on selling investments out of the market, that roller coaster can make your income feel pretty shaky. So, and the real pinch, for instance, is when you need your retirement dollars during a drop in the stock market, which means that you have to sell more shares to get the same dollars, which leaves you with less invested to recover later. This concept is known as sequence of returns risk, and it means that the timing of your gains and losses with the stock markets matter. This is a little bit nuanced, but super important. So if the market drops right as you're starting to take withdrawals during retirement, you're selling more shares at lower prices to get the same cash. Even if markets recover later, those early sales can leave you with fewer shares to bounce back, which then raises the risk of you running out of money, right? This is the most dangerous in the years just before and after you retire, when your nest egg is the largest and most sensitive to swings in the market. So let's picture this. We'll have two neighbors. We've got Alex and Jamie. Each have retired with $1 million, and each needs $4,000 a month to live off of. Both of them have the same average 10-year return. Let's just assume that. But Alex's first 2 years are down, while Jamie's first 2 years are up. So when Alex pulls money during those early down years, he has to sell more shares at lower prices just to get that same $4,000. Even if markets recover later, the bounce back only applies to the smaller pile of shares. So as you can imagine, 10 years in, Alex ends up with much less than Jamie. So same average return, very different outcome, all because of the order of returns. That's sequence of returns risk. In short, market volatility creates withdrawal pressure. Withdrawal pressure creates stress, not freedom. All right, so what does this mean for investors? Well, sequence of returns risk ties your retirement paycheck to Wall Street's mood. So when markets drop and you still need cash, that locks in the losses, which leaves fewer shares to rebound, and then if repeated, can shorten the life of the portfolio. Subsequently, this raises the risk of outliving your savings, even when long-term averages look just fine. So the remedy is structural, actually. Stop funding monthly needs by selling volatile assets. Instead, separate a growth bucket that can ride out swings from an income bucket designed to pay on a schedule. Okay, so let's talk about how to avoid this doom and gloom sequence of returns risk. Again, separate growth investments from your income investments. Let the growth bucket participate in long-term appreciation, but cap your stock market exposure based on your tolerance and time horizon. And then use your income bucket for predictable cash flow. So sources that are designed to pay on a schedule so that you're not forced to create gains at worse times. The mental and structural separation reduces the urge to make emotional decisions. So here's a simple framing that you can apply this week. Ask each line in your portfolio, is this primarily for growth or for income? If you can't answer, you may be asking one asset to do two jobs. So clarity around this helps you benchmark success appropriately. Growth assets are judged on a total return over time. Income assets are judged on reliability and risk-adjusted yield.